Hi, everybody. This is David Gully from Bentley University, and this is a very short explanation of how the Fed lowers the federal funds rate, which it did so today, September 18th, 2024. So let's first start with why the Fed decided to cut interest rates. And the general idea is that at the economy-wide level, aggregate demand and aggregate supply are now in better balance. Earlier, the high rate of inflation was caused by relatively constrained supply and relatively high demand, which worked both to push up inflation. With their tightening policy that they had implemented, the labor market cooled and the inflation rate declined pretty dramatically. And just in August, just last month, Chairman Powell talked about that the time has come for policy to adjust. And the idea here is, given he all but said that they were going to ease policy, they pretty much had to follow through or their credibility would be damaged. And in fact, in today's statement, the committee said that they're having greater confidence that inflation is moving back toward their 2% objective. It's not there yet, but given the data they've seen and how they project forward, they believe that inflation will return to roughly their 2% target. And they want to make sure that they don't do any more real damage to the labor market. And so the old federal funds rate target was 5.25% to 5.5%. And they just today announced that it was reduced by a half a percentage point down to 4.75 to 5.0%. So here's a visual on the inflation decline. At first, you can see that post-pandemic that the inflation rate rose very dramatically here and peaked out at just over 7%. And by the way, this is the Fed's preferred inflation measure, the personal consumption expenditures version of inflation. This is not the relatively more well-known CPI version of inflation, which increased at a higher rate. But here now you can see that the PCE version is now down to around 2.5%, and the Fed is expecting that it will decline even further, because even with the recent rate decrease, monetary policy is still relatively constrictive and will continue to work to put downward pressure on inflation. And so what we want to focus on here is, how do they go about lowering the federal funds rate? And so what we need here is the market for reserves. And what's critical is that the federal funds rate, which is their main target rate, that's the going interest rate in the market for reserves, which is determined by supply and demand conditions. So let's first look at supply. So where does the supply of reserves come from? Supply of reserves comes from the Fed when they buy securities. So the Fed undertakes open market operations where they buy U.S. Treasury securities and mortgage-backed securities from banks and other financial institutions. And when they pay for these securities that they buy, they are supplying reserves to the financial system. And what's crucial here, and we'll show this in a picture in just a second, the Fed has really excellent control over the supply. They can increase it and decrease it at a very finely tuned level. Now let's have a look at the demand. So where does the demand for reserves come from? Well, banks hold reserves for a number of reasons, to meet customer withdrawals, to make loans to their customers, to meet various regulatory requirements and so forth. And for our purposes, the federal funds rate is really an opportunity cost. This is one of the basic concepts in economics here, in that, other things equal, a higher federal funds rate gives banks incentive to conserve on reserves, in other words, hold fewer reserves. And so the demand for reserves has a standard downward slope that nearly all demand curves do. So it's really boils down to an opportunity cost argument. But now what's interesting, thanks to a whole number of reasons that we're going to skip over here for the purposes of this video, our demand curve also has perfectly elastic, in other words, perfectly horizontal components that come from two things. First, the Fed pays interest on these reserves. So the Fed, you can think of kind of a bank for banks. So when banks deposit reserves with the Fed pays interest, cleverly called interest on reserve balances. The Fed also pays interest to non-banks in the form of what's called the overnight reverse repurchase facility, the famous ONRRP. And so we'll have a visual here. And so here's what we have in the reserves market. So first we have the supply curve, the vertical component. This is from the Fed's open market operations with treasuries and mortgage-backed securities. And we're drawing it as vertical because the Fed has excellent control. It also has a horizontal component, and this is from the discount rate. And again, we're going to sort of skip over this component of it. So for us, this is not too important. But now we want to focus on, here are the two what are called administered rates, the IORB, interest on reserve balances, and the ONRRP rates that are paid to banks and non-banks respectively. And effectively what these help do is put a floor under the federal funds rate. And so that's why they act as kind of a horizontal component of the demand curve. And so here's the payoff of how this setup worked. This is called the ample reserves framework. So the Fed sets these two interest rates, the IORB and the ONRRP rate, and these are called administered rates. The Fed determines these. They aren't determined by market forces. The Fed announces what these are and either raises or, in this case, lowers them. And what tends to happen is the federal funds rate, which is a market-determined interest rate, tends to move into the range between the IORB and ONRRP rates. And here's the basic idea. By creating these two types of financial assets, interest on reserve balances and the ONRRP facility, the Fed effectively competes with any other entity that wants to borrow money, up to and including federal government, state governments, companies, etc. And so all these other entities that want to borrow money have to compete with the Fed. And so here, since the Fed is lowering these two administered rates, in general, short-term interest rates will tend to fall because now other institutions that want to borrow money don't have to offer as high as interest rates as they used to because the Fed has decided to lower these administered rates. Right, now here's the visual. So the way they actually structure this is under the old setup that they had until today, or actually technically tomorrow when they're going to change it, is the interest on reserve balances was 5.4%, and the ONRRP rate was 5.3%. And so what tended to happen is the federal funds rate would tend to be between those two interest rates. And the Fed is generally pretty good at getting the federal funds rate almost exactly in the middle, not 100%, but pretty close. And so what the Fed announced today was that these two administered rates are each going to be reduced by a half a percentage point, or in other words, 50 basis points, down to 4.9% and 4.8%. And so effectively what happens is those horizontal components now shift downward. And so what will happen is the federal funds rate will now tend to move to be in that range right there, right between 4.9 and 4.8%. Again, the key is that the Fed is now lowered these administered rates, and so other institutions that want to borrow can now offer themselves lower interest rates. So how well does this mechanism work? Well, our old target range for the federal funds rate, 5.25% to 5.5%, and to operationalize that, they had an IORB of 5.4 and an ONRRP of 5.3%. Their new target range is a half a percentage point lower. And so as noted, they've lowered the IORB and ONRRP by half a percentage point each. And the chart I've got here shows roughly the post-pandemic behavior of the federal funds rate. And you can see here that for a long time, the federal funds rate was targeted at what they called the zero lower bound. But then starting in 2022, they went through a series of 11 rate increases. And notice the stair-step function here. So in these situations, the Fed was raising its target range, and the federal funds rate moved upward in lockstep. And then in 2023, they halted this process. And so as you can see, the Fed funds rate stayed extremely stable. And so then what will happen beginning tomorrow when this new regime operationalizes, we would expect the federal funds rate to fall by almost exactly a half a percentage point precisely as the Fed wants. In other words, the Fed is really very good at getting the federal funds rate to be very close with its target range. So wrapping up here, the idea is that the ONRRP and IORB rates act as competition in the market for short-term funds. And so when the Fed lowers these rates, these administered rates, the other short-term rates also will tend to fall. And if you want some additional details, we have an entire playlist that discusses all kinds of interesting facts and exactly in very detailed fashion how the market for reserves works. Thank you so much.